We have Thanksgiving coming up, a shorter week this next week, but inflation clearly was part of the conversation because it put the Fed back in the middle of the conversation, and the market reacted to that because it certainly looks like inflation has begun to calm down.
It has. And, you know, the way that we're looking at it on our investment committee here at Annex is that you can kind of break inflation into the different drivers. There's part of it that's driven by the COVID supply chain issues, and then another part that's driven by on the demand side, which is more within the Fed's control. They can't do anything as far as building ports and things like that. And it seems like a lot of the reduction in inflation going from over 9% about a year ago down to closer to about like 3.2%, which was the most recent one. A lot of that was driven by things outside of the Fed's control. It was mainly supply side factors. And so we could see lower inflation going forward now that the Fed is having a big effect on the demand side of the economy.
And that's right. And the Fed is going to do probably some type of victory walk here. But what I'm concerned about, Brian, is that they reverse course too soon. And so here we are just before Thanksgiving, and they're looking at this PPI number that came out this week that showed that service costs were in line. And, of course, the dollar is stronger. And that's something that is kind of outside of their control. Both of those things together might suggest that rates are going to turn around in 2024.
It could. And the way that we're kind of positioning things as far as from a portfolio construction perspective is we're still getting good yields on cash and cash-like instruments. But when is the right time to start locking in those higher long-term yields? We think we're going to see a lot of volatility between now and, let's say, March, maybe even longer than that, mainly because the Fed, they want to convince the markets that they are on hold for a long time. And the market's pricing in 100 basis points of cuts in 2024. So 100 basis points, a full percentage point. That is a rather aggressive path of rate cuts. And I think the Fed is going to want to kind of push back on that. And so if they do push back on that, that means those longer term yields, we'll probably see some more of this whipsawing. Sometimes they go up towards 5%. Sometimes they go down towards 4.4, maybe 4.25. But we're probably in this range, this corridor is what we're referring to it as.
You know, when you leave the city and you start driving into the country and you start to get to these roads that are more rural, every now and then you might see a deer. And of course, to me, some of these Fed officials look like a deer.
They do. Yeah, a little bit like those deers caught in the headlights. And I think that is one of the things. Keep in mind, when they started, in a way, overdosing the economy on stimulus, they kept it going too long because they were afraid COVID was coming back. You look at the minutes of their meetings and they kept saying the path of the economy is going to follow the path of the virus. And so they kept monetary policy too loose for too long. Are they going to keep it too tight for too long because they're afraid that, you know, the second that they pull back on the tightening, that suddenly inflation is going to start reaccelerating again?
And of course, this wasn't just the Fed. There was fiscal policy as well. But I do now think that they're going to let time heal inflation from here on out, Brian. We're starting to see that in the 10-year Treasury as well, which has started to come down. And so really what it does suggest is that the Fed is going to monitor this, but as the election conversations start to heat up in 2024, I do expect them to reverse path.